Hello, I'm Professor Malcolm McDonald, and I've spent a big chunk of my life researching best practice marketing planning with the biggest and best multinational companies in the world, and also helping them to improve their own marketing planning. I'm also author of the book Marketing Plans, How to Prepare Them, How to Profit From Them, a book that's sold over 500,000 copies worldwide. This is the very first time that I have attempted to put all my learning and experience into an online course. It consists of 10 modules, and I know that you will learn from them, you will enjoy them, and much more importantly, that you will implement them to your benefit.
You will see that the title of this online workshop is Marketing Planning, How to Develop a Strategy to Grow Sales and Profits. If you follow this online workshop and implement each of the 10 modules, you have our promise that you will end up with a world-class marketing plan which will help you to grow your sales and profits. To start this online workshop, we will spell out the objectives and the structure. You will see from this slide that we will start with Module 1 by briefly reviewing the past 50 years of management. The purpose of this is to draw conclusions before looking to the future. The second module shows how to focus scarce resources on the best opportunities. Module 3 spells out the role of marketing strategy in creating shareholder value. Module 4 shows how to begin the strategic planning process. Modules 5 to 8, which are the core of the total online workshop, show how to prepare a winning strategy to grow revenue and profits. That is modules 5 to 8. Module 9 links marketing strategy quantitatively to shareholder value. And finally, there is a module with some conclusions and some kind of summary. The vehicle that we will use will be 10 questions Chief Executive Officers and Chief Financial Officers are asking their senior marketers and the answers they should be receiving. Most importantly, 12 action points are given at critical stages of the workshop. Some modules will be longer than others because of the nature of the content, but in general, you should be able to complete each module in under 1 hour, plus of course the implementation exercises included at the end of each module. So, we are now ready to start this 10 module workshop on marketing planning.
Module 1 reviews the last 50 years of management prior to looking forward to the amazing future that marketing can play in the profitable role of organizations. You will of course recognize many of the silly mistakes that I refer to, and I know that you will look forward as a result of this module to a positive future for marketing.
Let's begin then with Module 1, which briefly reviews the last 50 years of management prior to looking forward to the next few years. You will find that my review which follows is fairly critical of management over the past 50 years, in the hope that we can all improve in the future. You will see from this slide that I start my review in 1760, which was the start of the Industrial Revolution in the United Kingdom. This takes us through to today. The horizontal axis describes different phases of management. The first two, technology and production, were the principal features of the Industrial Revolution and resulted in millions of people moving from the countryside to towns and cities. Please observe, however, the point of inflection on the curve, which indicates that supply eventually became greater than demand. The people then had many new products to choose from, and with the exponential growth had a choice of which to buy. This led to what I refer to as the sales phase, because suppliers had to begin explaining the benefits of their particular products. In reality, this was where what today we call marketing began. I will come to marketing itself shortly. In the meantime, there have been hundreds of what I call fads developed over the years. I have identified over 300 of these fads. I've called them fads and am critical of them because without a marketing foundation, which involves a deep understanding of markets, segments and customer needs, very few of them will be effective. The better known of these include business process re-engineering, balanced scorecards, CRM systems, relationship marketing, and so on. And of course we now have the likes of big data. All of these so-called fads in reality are excellent, but only, as I said, providing we have a deep understanding of markets and customers and their needs. That leads us to the next phase, which I have called accountancy. And this is something that we will all empathize with, because we have all experienced it and suffered from it. Accountants, with their exotic short-term debt instruments and their vicious cost-cutting, have been a feature of the commercial landscape for many years now. The question I ask is, how many pence are there in a pound? How many cents are there in a dollar? How many cents are there in a euro? How many of these can you cut? Clearly this is finite. Whereas value creation, which is the business we're in as marketers, is infinite and is only limited by our creativity and imagination. This phase, the accountancy phase, still current alas, leads to what I call anorexia industrialosa, which is an excessive desire to be leaner and fitter, leading to emaciation and eventually death. It's interesting to note, for example, that the United Kingdom has 12 times more accountants per capita than Germany, and we're all aware of which of these two economies has been more successful over the past 50 years. The top phase in this slide is called marketing, and my belief is that we now have a fabulous opportunity to change commerce for the good, and we will show you how to do this during this workshop. So, let me summarize just some of what has happened to commerce during the past 50 years. Fads we've already dealt with, at least some of them, and I've explained why many of them, in spite of their inherent excellence, don't work effectively without a proper marketing strategy. The second of my bullet points here is digital strategy without marketing strategy, and it's exactly the same problem. Without a robust marketing strategy for what you sell, who you sell it to, and why people should buy from us rather than from somebody with something similar, it is impossible to have a sensible or workable digital strategy. The third bullet point talks about the problems with profit and loss accounts and balance sheets, and the final one talks about the failure to develop financially quantified value propositions. And I will deal with each of these in turn, starting with digital strategy. The digital revolution is here to stay, but like most of the fads I referred to earlier, it is largely ineffective without a winning marketing strategy. As Nicola Kemp said in the quotation on this slide, for many companies the greatest threat is not being out of touch with digital developments, but losing sight of the fundamental needs of their consumers and the underlying long-term drivers of their business. Two fabulous cartoons follow to explain what I mean. We've all suffered the frustration of trying to contact a real person in our supplier's company, and this cartoon here expresses the frustration very well. As you can see, it says on the line, This call may be monitored for research purposes to determine how long you'll stay on hold before hanging up. This cheeky cartoon here shows a chief marketing officer standing in front of the operating board, and as you can see, he is saying, although our quarterly earnings dropped by 25%, I feel compelled to point out that our Facebook likes have doubled. Yes, of course it's an exaggeration, but the reality is that boards of directors really couldn't give a toss about Facebook likes, and it's got very little to do with the underlying success of the business. There are, of course, many more cartoons of this nature, but I think I've made the point, and I'd like to turn my attention now back to the accountancy domain. And this slide says the financial information problem, time lag, and the limited value of profit and loss accounts without market-based information. So I'm going to bore you with one or two profit and loss accounts. And just as a matter of interest, I should like to point out, as we all know, that most profit and loss accounts have one line for revenue, and most of the rest of it is about costs. And the directors of the organizations tend to spend their time not talking about the revenue and where it's come from, but spending their time on the costs. As promised, this next slide is a typical profit and loss account. You'll see it is called Intertech, which is a real company, but obviously disguised for the purposes of confidentiality. And without boring everybody to death, I will just headline a few comments. The first thing to remember to observe is that the revenue practically doubled over a 5-year period. The contribution earned almost doubled over a 5-year period. And if you look at net profit, it almost tripled. If you look at return on sales, that doubled over the 5 years. If you look at asset turnover, that went up. And if you look at return on assets, that almost tripled as well. So in theory, what you're looking at here is a very, very successful company financially. The problem, however, was that they just happened to be in a growth market, and their market was about to downturn in a quite severe way. So let's have a look at some much more interesting and useful information to inform the board of directors about what was really happening during this 5-year period. Let's now turn our attention to some very useful and informative marketing information, particularly market-based information. A quick look at this slide will show you that the market grew much quicker than Intertech did over the 5-year period. The result of that was that their market share went down from 20.3% to less than 15%. On its own, that is not a problem, but there were other telltale signs that the board didn't get to hear about. The first one you'll see is called customer retention. In the base year, they used to keep almost 90% of their customers, but 5 years later, they were losing a third of their customer base every year, and I'd like to come back to this in the next slide. If you look at dissatisfied customers through market research, you'll see that that's gone up from 13.6% to 19.6%. If you look at relative product quality, they used to have a super product. Now it is what I would call a pimply little me too. Their service in the marketplace is now, if you look at the last line, is now negative in the marketplace. Relative new product sales, according to their competitors, used to be good, now it is negative in the marketplace. So you will see that there are quite a lot of very, very bad and very negative trends happening in this company's marketplace, which the board didn't appear to know about. The result, of course, was disaster, because once the market turns down and you're not aware of these fundamental issues, you are likely to get into serious trouble. So I'd now like to turn my attention to the customer retention issue, just as one indicator of the problem facing this company. As promised, Here you will see a deeper explanation of customer retention. What we have done in this case is to break the market down for Intertek into 6 segments. And you'll see on the first line, you'll see the percentage of sales volume accounted for by each segment. The next line shows the percentage of profits accounted for by each segment. And if you look again along the top line, you'll see that the biggest segment, segment 3, accounted for 27.1% of all revenue in the market, but only 14.7% of industry profits. If you look at the very last one, segment 6, you'll see that this little segment accounted for just over 10% of all volume and revenue, but almost a quarter of industry profits. And if you study this in a bit more care, you'll see that there were some other quite spectacularly successful, profitable segments where their performance, Intertek's performance, was not very good. But let's draw your attention to the segment 3. In segment 3, if you look at the green circle, you will see that Intertek's defection rate was 15%, which means they're losing 85% of all customers in that segment. And it's not very good, but the interesting thing is that their best performance is in the worst segment of the marketplace, segment 3. If you look along to the right, you'll see the red circle, which is the very profitable segment, and there are others like this one. You'll see their worst performance, 35% customer loss in a year, is in the very best and most profitable segment of the market. Let me summarize the points I'm making on customer retention measurement. You'll see from the first bullet point that companies report the customers they gain, but rarely do they report the customers they lose. This is in spite of the fact that a 5% increase in customer retention can increase profits by up to 75%, unless, of course, Harvard Business Review, Bain & Company, Forrester, and many other famous companies are all telling lies. And we know they're not telling lies because clearly keeping a profitable customer is far preferable to losing one and having to spend money to gain another one. And the final bullet point: customer acquisition is like hunting, retention is like farming. Hunting is exciting, farming is boring. And I can only assume that this is one of the reasons why marketers tend not to report the customers they lose as well as the customers they gain. Let me just summarize the point I'm trying to make about the profit and loss account deficiencies, and referring back to the Intertek slide, the first Intertek slide. Clearly, without market-based information, the financial data reported in profit and loss accounts is not very informative. And I and my colleagues often wonder what marketing people think their real role is. Clearly, as well as spending time on things like digital, they should be feeding market-based information to the board to help explain the financials. Let me conclude this section by saying that cost-cutting and short-term financial success can be very short-lived. And I give you an example of the tendency to want to cut advertising budgets. If you look carefully at this slide, and I can tell you that there are at least 900 well-documented case histories very similar to this one, held by the Institute of Practitioners in Advertising, you will see that if you cut the advertising budget completely, that money goes straight into the bottom line, but that success is very short-lived, and you'll see that it takes 5 years to get back to where we started. If you cut it by half, it takes 3 years. One of the reasons or explanations for this, of course, is that expenditure on marketing tends not to have an immediate impact, particularly if it is related to trying to change customer attitudes. So we need to become a bit more sophisticated about how we explain what we do and what its financial impact is, and we will come to this later in this online workshop. Staying for a few more minutes with the financial side of management, let's turn our attention briefly to balance sheets. And you'll see that whilst accountants don't measure intangible assets, the discrepancy between market and book values shows that investors do, and I'd like to show you a couple of balance sheets. As you know, the purpose of a balance sheet is that it should balance, that is, the left side, what we own, should match the sources of finance. These are labelled assets and liabilities. The problem occurs when a predator offers you 100 million and of course you refuse and eventually settle for a price of 900 million. The problem now, of course, is that the balance sheet no longer balances. This doesn't present a problem to accountants, however, as a sneaky little balancing factor is now added, labelled goodwill. In this case, £800 million. What this 800 million balancing figure is, of course, is the size of the mistake made by accountants in valuing a company, and the first time the size of the mistake comes to light is when someone buys it. Now yes, of course, I know and understand the international financial rules, having been chairman of a global brand valuation company, but the point I'm making here is that tangible assets in most organizations rarely represent the real value of the company, which resides in brands, relationships with customers and the like, which generally speaking do not appear on the balance sheet. One of the best examples of this is shown in this slide. Procter & Gamble, who obviously are no idiots, paid £31 billion for Gillette, but got only £4 billion worth of tangible assets. Likewise, when Nestlé bought Rowntree's, the last thing they wanted was a factory in York. Obviously what they wanted was the brand names and the relationships with customers rather than a factory. If you look at this particular slide, you'll see that in the United States, 73% of all corporate value resides in intangible assets, whilst in the United Kingdom it is 64%. Interestingly, the global intangible value of all quoted companies is 53%. The whole point of providing these figures is to remind all of you that the real value of any organization resides in their relationships with their markets and their customers, a topic that we will expand on later in this workshop. Just to conclude this section on financial and marketing aspects of commerce, a quick look at this chart will indicate the approximate value of some famous brands according to Interbrand. You will observe that most of these values are bigger than the gross domestic product of many nation states, surely an indication of the crucial role that marketing plays in business. Let me now turn to the last item I want to discuss in my review of the last 50 years of management. As you can see from this slide, according to McKinsey, only 5% of United Kingdom companies have got clearly articulated written value propositions. My own estimate is that only 2% of UK companies have what I call financially quantified value propositions. For any organisation today, creating differentiation that the customer needs is far more challenging than at any time in history, but it remains at the heart of successful marketing. More importantly, it remains the key to a company's survival. The truth is that if you are in an overcrowded market where you don't stand out, all lowering prices will achieve is to erode your margins, and unless your business costs are lower than anyone else's, discounting is a losing game. The alternative, of course, is successful differentiation. If you can't come up with something genuinely different and better, there isn't much future for your company. However, before I explain how to go about this, I want to point out that because of technological advances, product differentiation is unlikely to win in the long run. purely and simply because this is comparatively easy to emulate today. Much more likely, differentiation will result from the way you relate to your customers. For now, let's call this customer service, and I'll explain later the myriad of forms that customer service can take. One such form is the result of market segmentation, and we devote a whole module in this workshop to this fundamental form of differentiation and competitive advantage. For now, however, all I want you to understand is that differentiation is the key to commercial success and must be encapsulated somehow in a value proposition. Let's start by having a look at the figure in this slide. It is used by most buyers in most markets, the only difference being that the vertical axis is sometimes labelled differentiation, high or low. The most important box to look at is the bottom right box. Here the buyer orders a lot and can get it from virtually any supplier, so not surprisingly they buy on price. The bottom left box, low differentiation, and the buyer does not purchase a lot, represents a great opportunity for small, medium enterprises to take responsibility from the customer by means of outsourcing. The top left box, providing the company offers something different that the customer really values, is an even better opportunity because even though the customer doesn't buy much, price is rarely important. By far the best box to occupy is the top right box. Buyers order a lot and they really value the differentiation offered by their suppliers. Here it is not unusual for them to pay up to 20% premium to deal with such suppliers. The bad news, however, is that the low differentiation axis nearly always leads to very low prices and margins for suppliers. This is all right, however, providing at least some of the main products or services you supply are differentiated, and it is to this point that we now turn our attention in the context of value propositions. Start by having a look at your own website. Typically, suppliers' websites say things like, "We're trustworthy, we have an outstanding reputation, our products have great quality, we're the market leader in, we help our customers to get good results, our customer service is excellent, we're innovative, etc., etc. Me, 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 me." Everybody sounds the same, and in the main, customers just don't care. All customers care about is their bottom line. They don't care about you. Customers expect their business to be better off as a result of dealing with you, and you must be able to prove that dealing with you will create advantage for them, not merely help them to avoid disadvantage. A value proposition has 4 potential parts as shown in this slide. The first is added value, and what I have done is listed at the bottom all possible items that could contribute to added value. Second one is cost reduction, the third one is cost avoidance, and the fourth one is emotional contribution. And the first 3 are comparatively easy to quantify, the last one less so, although particularly with well-known brands such as SKF, IBM, General Electric, 3M and the like, they are often high on the business agenda. An excellent example of this is SKF, the Swedish bearing company. They have a global president of value propositions, and they tailor their value propositions to each customer. This shows a generic example, but from this it can be seen that over the life of the bearings, the significant premium over the bearings of competitors saves the customer $30.25, representing the quantified added value. This slide is a test we have been conducting with most of our audiences over the past 3 years. Recently, for example, I had an audience in London of 1,000 marketers, and 2 days later I had an audience of 800 marketers. On showing them this slide, the honest response, it's honest because we have an audience response system, was less than 2%. Just to remind ourselves, this slide shows a summary of this first module. I discussed fads instead of marketing strategy. I gave some examples of why digital strategy doesn't work. I spent some time talking about the problems with profit and loss accounts and balance sheets. And finally, I talked about the failure to develop financially quantified value propositions. You have kindly listened to my own critical views on the past 50 years of management. I have deliberately focused on what, in my view, has been done badly. I will spell out what excellent marketing is later. The result is that we in marketing now have the best possible chance to shape the business future. Before I move on to show how this can be done, are there any lessons you can take from my critique? Can I suggest that you make a note of these? To conclude this first module, we include the following exercise for you to complete. This exercise will give you an excellent indication of whether your company is thriving and not relying merely on forecasts and budgets. Please place a tick after each statement in the column that most accurately describes your company situation. On completion, please use the quantitative evaluation method that we have shown in the last slide. This is the first part of the questionnaire. This is the second part of the questionnaire. And this is the final part of the questionnaire. And finally, this is how you interpret exercise 1. We're now ready to move on to module 2.